To understand why tax planning is so important, we need to look at the retirement tax landscape. It's not just about one source of income. It's about how different types of income are taxed. As you can see from the graphic, your retirement income can come from multiple sources, and each one is taxed differently. You have withdrawals from your traditional IRA and 401ks, and these are taxed as ordinary income, just like a paycheck you receive while working. Then you have capital gains from selling stocks, bonds, and other investments. These may be taxed at a lower rate, but they still add to your income. And here is the big one that surprises a lot of people. Up to 85% of your Social Security benefits can be taxed. The amount that is taxed depends on your total, quote, combined income, which includes all your other taxable incomes. Retirement income is taxed differently. Managing this complex web of income requires planning. This is an important strategy in retirement. The goal is to control your taxable income each year by being smart about where you take your money from. First, start with your taxable account. Like a brokerage account, you already pay taxes on the money you invested, so you only pay capital gains tax on the profit. Now you can withdraw it from your tax deferred accounts. This is like your traditional IRAs and 401ks. Every dollar you take out of this account is usually taxable as ordinary income. This is where your RMDs will come from. Take out what you need and what is required. Then finally, take it from your tax-free account. And these are your Roth IRAs. And you take them last because all the withdrawals are tax-free. This is the perfect source of income to draw from when you want to avoid adding to your taxable account for the year. Since this money is so valuable and will never be taxed again, you want to preserve it for as long as possible. By controlling your income and taking it from the right account at the right time, you may be able to control your tax bracket. The goal is to keep your income low enough to avoid triggering higher tax brackets and to prevent or minimize the taxation of your Social Security benefits. Beyond the withdrawal order, there are other powerful tools you can use to lower your taxes. First is tax loss harvesting. This is a strategy where you sell investments in your brokerage account that have lost value and to harvest these losses. You can then use those losses to offset any capital gains you realized. And if you have more losses than gains, you can even use up to $3,000 of those losses each year to reduce your ordinary income. The second is qualified charitable distributions, or QCDs. If you're 70 and a half or older, you can instruct your IRA administrator to send a distribution directly from your IRA to your qualified charity. This distribution counts towards your RMDs, and it is not included in your taxable income. Let me say that again. Your QCD taken from your IRA is not included in your taxable income. These are just a couple of excellent tools for saving on taxes. A QCD is powerful if you are charitably inclined and are taking RMDs because it allows you to satisfy that requirement without increasing your taxable income, which can save you money in the long run. This may be helpful when trying to keep your Medicare Part B and Part D expenses down. In retirement, small changes in your annual income can create powerful ripple effects throughout your financial life. For example, Social Security taxation. Your income level directly determines the percentage of your Social Security benefit that the IRS will tax. And then we have Medicare Income Related Monthly Adjustment Amount. Oh, what a mouthful. IRMA, IRMAA. This is a this is critical. Medicare Part B and Part D premiums are based on your income from 2 years ago, what you reported to the IRS. If your income crosses a specific dollar threshold, you could be pushed into a much higher premium bracket. Yeah, we're talking about hundreds of dollars a month, all because of $1 too much taxable income. In a future lesson, we will discuss IRMA in more detail. So, in retirement, a small proactive adjustment to your income can save you money while a careless move can cost you far more than you realize in premiums and taxes. Now that we know your income controls your Social Security taxation, how exactly does the IRS calculate this? Well, they have something called, quote, combined income formula, end quote. You don't need to memorize it, but you need to understand what goes into it because this is where the planning happens. The formula is essentially your adjusted gross income. And these are your wages, capital gains, interest, dividends, retirement distributions, pensions, etc. Plus, you add on your tax exempt interest that you might have from mutual bonds. And then you add, and get this now, 1/2 of your total Social Security benefit. And you add all these things together and you have what's called the combined income. Based on your combined income, this is where tax planning can help. There are cliffs for the taxation of your Social Security benefits. We're going to be using examples from the 2025 thresholds. Using the combined income formula that we discussed in the previous slide, we're going to show you how this can affect individual filers and also joint married filers. So if your combined income is under $25,000, there's no federal tax on your Social Security benefits. Now, if you go $1 over 25,000, then up to 50% of your benefit can be taxed. And then if you go over 34,000, you hit the maximum. 85% of your benefit can be taxed. Now, for married couples, it's similar, but the threshold is higher. Up to 32,000, no federal taxes on your Social Security. Over 32,000, up to 50% can be taxed. And then if you go over 44,000, then you hit the top 85% tax rate. These thresholds do not adjust for inflation, which means more of your benefits are taxed over time. So, it's important to try to control our taxable income. Pushing your combined income just $1 over the line can immediately expose you to an additional 35% of your Social Security benefit to be taxable. That's a very expensive $1. If there's one thing I want you to take away from this presentation is this. You can't just think about taxes in April. Effective tax planning isn't an annual chore. It's a year-round process. Every financial decision you make, whether it's selling an investment, making a charitable contribution, or deciding which account to withdraw from, has tax consequences. By being proactive and thinking about taxes throughout the year, you can make smarter financial decisions that can make a huge difference in your retirement.